Игорь, слышите меня?
Да, слышу.
Я думаю, вы можете начинать уже, а
Ага.
люди будут подключаться впоследствии вашей лекции.
Okay. Okay, let's start then. Let me briefly introduce myself. My name is Igor Konopлястый. I've got investment banking background, a financial background. I used to work at Renaissance Capital as the start of my career. I also used to work at different family offices as a financial manager. In 2012, I switched to operational roles in the IT sector. I held different roles as head of business development and chief executive officer in several companies. So I've got lots of practical experience in terms of managing financials, managing processes, managing teams. So today I'm going to share my practical experience, not theory, not others people experience, but my experience. So I hope it's gonna be fancy for you. Currently I hold the role of Chief Financial Officer at a company called S Photonics. We develop emerging data storage technologies. It's a US company. Hopefully you're gonna hear about us in the next 3, 5 years. Today I wanted to talk about crisis management in tech. Basically not only in tech, but in general in companies. How to rapidly restructure business if you understand that your business is going to be bankrupt in the next several months. How to return to profitability, how to make a pivot of your business in the right moment. We will talk about financial discipline today. Let's start. So there is a problem. Many companies, not only startup companies, but also established ones, mature ones, they tend sometimes to die actually. So because C-level managers, founders, financial officers don't foresee the failure. Uh, and I will tell you several patterns how I see when companies tend to die. Startups, there are two ways to die, in my opinion. Fast growth trap. For example, you get lots of investments. For example, 1 million investments from different investors, and at the same time, your revenue is growing pretty fast. But at the same time, you are burning, for example, $100,000 per month, and your run rate will be roughly 12 months. But tell yourself, you tell your investors that this is fine. We're not profitable at the moment, but we will be profitable when we are big, when we scale up. When you find yourself in 8, 10 months, you realize that you don't have cash anymore to finance your business. Uh, okay, your revenue is very high, but and you cannot scale up anymore. You cannot run your business anymore. And most likely, if you don't foresee it, like in 2 or 3 months before the failure, you will die as a company. So you need to understand that it's better to look not top down, like top is the revenue, down is the net profit. So you're not looking top down, you're just looking bottom up. You need to understand that you are burning too much money and to stop it when you realize that you don't have enough cash to finance your business anymore. The second pattern is my favorite one, actually. Um, uh, it's about scaling. So you need to understand that the main problem is when you start scaling losses. So scaling is a multiplier, actually. So it's an instrument which multiplies. So it doesn't change minus into plus. It just multiplies your losses and it multiplies your profits. For example, if you have $1,000 loss, you multiply it by 10, you scale up business by 10 times, so you get 10 times losses. You get $10,000 losses in the end. And the same about profits. If you scale up profits, you get profits. So never ever scale losses, just scale profits. For example, you've got a product on your home market, which is not, which is loss making. It's not profitable, and you are trying to scale it to different geographies. Of course, you're gonna fail. Never scale losses, scale profits. Um, Other two patterns. We can talk about these patterns as patterns for established companies, but um, it's fair to talk about these patterns when we discuss startups as well. I will start with the fourth one on this slide, which is called hidden segment. What it means. Uh, for example, when you start your business, you've got, I don't know, two free revenue streams, two free products, and you've got like revenue one, revenue two, revenue three. You divide those revenues on your profit and loss accounts, on your financial statements, but then you need to divide your expenses, your costs into these three divisions. So they need to, your costs and your expenses need to correspond with your revenue streams. Otherwise, you don't understand what's happening in terms of costs and expenses when talking about different segments. So, for example, you've got three revenue streams, and you've got one development team, one marketing team, one financial team. Uh, you need to understand how to allocate each cost to each revenue stream. So this is very important. The last but not the least, this is product unfocus. This is more about established companies. I faced it a couple of times in my career. When you run your business, for example, for 5, 10 years, and you've got a very established, very good business, which gives you lots of revenues, lots of profits. You've got very good team. You've got like everything is good. So your business processes are well established. So at some point, founders become bored about these kind of situations, and they are trying to invent something new. They trying to start new projects. They but this is okay, but don't ever start new projects, new companies inside your established company. Never. You just need to spin off first your established product, then you can start a new one. Of course, you can develop your established products into new segments, into new revenue streams, but this should be like one big segment, not like a new market. So many founders fail because they want to invent something new. They took all the profits from the established business. They took the best people from the established business. So they cannibalize, basically they cannibalize their established business, and they fail with the new one. So no one wins here. So think twice before you want to start something new inside your current business. So we've discussed four problems. Let's get to the tools, how we can foresee our problems, how we can solve our problems, how we can save our business. Um, so there are three tools I use. This is not, as I have already said, this is not like a theory. This is just my practical experience. Um, I use always three basic tools uh, to validate if my business is safe and sound, or I should be I should start being nervous about my business. So, second. The first tool is management accounts. You need to prepare correct management accounts, correct financial statements, in other words. So you need to show your profit product by product, not one number for the whole company. The second tool is unit economics. Well, basically, I will talk in more details about these tools in a minute. So it's just to sum up those tools. So the second tool is unit economics. Does one client earn or lose money for you? If one client loses money, then you need to tune your unit economics, because it doesn't work. You cannot scale up your business. The third tool is pivot. This one is not a measuring tool. This is what you do after the numbers tell you that your current business model is wrong. It's not working. The important part about these tools, none of these tools are complicated. Basically, the first one, management accounts, it's just simply a spreadsheet. The second one is division, because it's about lifetime value and customer acquisition costs. You just divide one by one. And the third one, the pivot, is a decision. So let's go to tool number one in more details, which is management accounts. So let me show you how it looks like. Here is a simple example. Well, what I'm telling you, it's not a rocket science. It's just simple examples how to validate your current business. So, for example, you've got three products: product A, product B, product C. Each product has revenue. For example, product A has revenue of 100, no matter what. And the net profit of this product is 30 something. This is a good business. This is profitable enough. So when you see it, it's pretty okay. Product B, it has got revenue of 40, but the net result is minus 21. Product C, revenue 20, net result is minus 24. And now we look at the last column. The total is minus 15. Well, and this is the whole point of the slide. If you have one P&L, one financial result for the whole company, you only see minus 15. You see that the company is losing a little money, so you will probably cut costs everywhere across all the products. You will cut the costs equally to fix it, and most likely you will damage your product A. This is the only product which makes net profit for you. There are three basic rules for making management accounts properly. Rule number one: every product and every project should get its own column, including new projects. So you always need to divide your products column by column. Don't mix them together. Never do this. Because otherwise you're gonna get bad numbers, they won't show you what's happening with your business actually. Rule number 2, you should allocate all the costs correctly, smartly. I touched based it earlier. Let me explain it to you in more detail. So, for example, product A, you know that this product is very established. You know that your development team doesn't spend more than 10% of their time on this product. So you allocate only 10% of your costs, of your development costs onto this product. You don't like split it. If you have 3 products, you don't split all the costs like 30%, 30%, 30%. You need to make it smartly. So you need to dive deeply into the costs, and you need to understand which product consumes which costs. So, for example, I have told you about development costs. For example, marketing costs. You understand that when talking about product A, you spent lots of on Google ads, on Facebook ads, but product B, it gets lots of organic traffic. So you can allocate, for example, 15% of the marketing budget to product B. So I think that you got the what you should do, how you should allocate the costs. So the last rule, rule number 3, you need to update your management accounts every month, not once a year, not once a week, not once a quarter, but just monthly. You should bear in mind one important thing. This is not for taxation reasons. This is not for your tax office. This is just for you. You need to understand how you rule your business. You need to understand which revenue stream generates which costs. This will make your life easier, much easier. And at this point, when you see, for example, some of the products they are not profitable, you understand that these products have not been profitable for the last, I don't know, 6-8 months, and just be brave, just cut them, cut those products, cut those business processes. Don't cry about them. Of course you can cry, but just cut them, just cut and forget and go ahead. You'd better invest the money you save on cutting those 2 products. You'd better to use this money investing in product A, or expanding this product A into different other segments. I see a question here. I will answer all the questions after I finish this presentation. Let's move to tool number 2, which is unit economics. So this is about LTV. It is lifetime value. Basically, it's a gross profit from one client over all the time they stay with you. Customer acquisition cost, or normally people say CAC, but I don't like how it sounds, so I prefer CAC. You can pronounce it whatever you like. So customer acquisition cost is the money you spend to get that client. So this approach was invented by David Skok, serial entrepreneur. He analyzed more than 100 software companies over 10 years, and he noticed something. He noticed something about this ratio. Where he noticed that when the ratio is 4:1 and above, this means that your company is healthy. So the only recommendation he gives you is to grow. So you need to take some actions. You need to continue hiring salespeople. You need to buy more ads. You need to find more marketing channels to invest in. So here, the more you spend, the more you earn. So don't miss this one, because sometimes the problem is that sometimes you don't scale up when you should, and you scale up when you shouldn't. So don't miss this healthy ratio when it's 4 to 1 or above. So the second line is when your ratio is 2 to 1 or 3 to 1. So you need to become skeptical about your unit economics because it's a bit weak. And because, for example, if your churn goes up immediately or your ads goes up at some point, ads price goes up at some point, you will start losing your money immediately. So be careful when your unit economics ratio is 2 to 1 or 3 to 1. So you need to fix it first, go back to 4 to 1, and then you need to scale up. Two bottom lines. This is not what we want to see in our business. So this is the red lines, the red flags, whatever you call it. So when the ratio is 1 on 1, that means that you invest $1 and you get back $1 on the gross profit line. So basically, on the bottom line, on the net profit line, that means that most likely you are making losses. And the last line, which is below 1 on 1, when you are just throwing your money like out of the window. This means your company will die in the next couple of weeks or months. Let's go to the third tool, which is called the pivot. As I have already mentioned, this is not the measurable tool. This is just the way you should behave yourself and when you see wrong numbers. Many people think that pivot means that you throw everything away, you start again from scratch. You sack all of your team, you hire a new team, you start establishing a new business. No, it's not a pivot. That means that you are closing your company and opening a new one. A real pivot is when you keep almost everything. You keep your platform, you keep your technology, you keep your team, you keep everything. You just change one thing. This is why a pivot can be fast. You do not basically rebuild your business, you just make the right turn. There are different types of pivots. Type 1 called zoom in. For example, there is a good example of Instagram. There was an app called Bourbon. And they had 10 features in the application, but only one feature was working well. This feature was about showing and sharing photos with other people. So the team of the application, they decided to delete 9 features. So they deleted 9 features and they turned into Instagram. And we know the story about Instagram. They became a unicorn and stuff like that. So the hard part about this pivot is not seeing this. The hard part is deleting your own work. So I have mentioned this already. You shouldn't be scared about deleting your own work if it's not working. So it's only about arithmetics, mathematics. If you see that something is not working, uh, don't be scared to delete it. Just do it. Type number two, called zoom out. For example, you see that you develop some kind of a product in-house. You use it for your own team, um, and you understand that your product might be useful for other teams, for the whole of the market. This happened, for example, to Slack. The guys were developing a game company, and they were using an internal chat tool inside their team. And the founders saw that every team in the world needs this tool because this tool was very effective for communication inside their team. So after they closed the game, they launched Slack, which is now worth tens of billions of dollars. So this is zoom out pivot. Sometimes you just don't need to change anything about your product. You just need to change the customer. So you just switch from like small business to enterprise businesses, because small businesses, they pay little, they have high churn, they make many support tickets for your team. So it's much easier sometimes to switch to enterprise companies, which don't change the products they use very quickly. So sometimes it's better to change the customer. So the main rule about pivots, a pivot starts from what already works. So you just gather your data, you analyze your data, you follow your data, and if you decide that something is not working, think about making a pivot. So we have discussed three tools I basically use to validate if the business is working good or not. Let's switch to my personal experience. I've got three case studies here. Um, well, it was long ago, like 10 years ago. I was CEO of a company called Sravni Kupi, which is compare buy if someone doesn't speak Russian. This company was it was an online supermarket for insurance, like Compare the Market in the United Kingdom. Maybe you know it. Or Bankiru or Sravniru in Russia, for example. So what we were doing, we were making telemarketing sales of different insurance products. And the main problem about this was that this business is very capital intensive. To run this business, you need to hire lots of people, you need to educate those people, you need to buy lots of equipment, you need to spend lots of money on telecom services, you need to hire managers who will be ruling those people. So you need to rent some spaces for those people. So lots of expenses. And at the same time, our revenue was very high. Our turnover was very high, where we were rapidly growing with lots of revenues coming in. But at the same time, due to these high expenses, high costs, we were losing a lot of money. So we were loss making. Our LTV ratio, our unit economics ratio was less than 2 to 1. So we were basically like selling for $1, getting $1 back. And we were living only because we had lots of cash turnover. Um, what we decided to do when we sat down and saw those numbers, we decided that this business doesn't work. We are not experienced enough in terms of making call centers. We're not experienced enough in ruling those operators. So we just better switch to something else. And we decided to switch to lead generation. So we started selling those leads who were coming to us through our website, through our partnerships. We started selling those leads to insurance agents, to insurance brokers, to insurance companies. And in the end, of course, our turnover dropped dramatically, our revenue dropped dramatically, but at the same time, our costs dropped as well. And our cost dropped more than our revenues. So we became break-even. It was not a very profitable business, but still we were break-even. And one more thing I want to mention here, I haven't mentioned it when I was talking about patterns, why companies die. But this is a very important thing I want to mention. I know many companies try to invent something in-house, like different IT instruments. For example, CRM systems, and other stuff. So we at Shravnik UP, we were we had 10 developers at some point, and we were developing our own IT systems. We were developing 2 CRM systems. We were developing our own website with our own CMS systems. And this cost us, like, I don't remember, but it was lots of money. We wasted lots of money on this. I just beg you, don't have develop any internal in-house systems which you can buy from the market. Moreover, today you've got lots of AI tools. You can use them. For example, you don't even need a designer today. So you can design any website, any landing page, any application by yourself using Claude or ChatGPT or any other AI tool. So yeah, don't do this. Don't repeat our mistakes. The next one. The next one called UCause. Those people who are as old as I am, maybe you remember this tool. It was founded in 2005. I wasn't among the founders team, but I joined them in 2018. And when I joined, I saw the following. I saw that there is a very good product called UCause. It's a website builder. It was basically the #1 website builder in the CIS like 15 years ago. So I saw that there is a very good profitable UCause business which generates lots of revenue, lots of profit. But at the same time, there are lots of different other products which were developed in-house, and the main problem was that the financial statements of the company, there was a hidden segment, as I mentioned above. There was a hidden segment. So there were some revenue streams, like UCause revenue stream, UKIT revenue stream, other revenue streams, but the costs of the whole company, they were hidden in one column, as we were discussing above. So, and the bottom line was like break even. It was zero there. So no profit, just zero. And I became a CEO of the company in 2021. And the first thing I just used tool number one. I prepared correct management accounts. And what I saw when I prepared correct management accounts, I saw that only one product is profitable. The other products, like 10 products, smaller ones, they are all loss making. And there were like 100 people in the company. And most of the people were working for these loss making products, loss making projects. So what me and my team did, we just killed those loss-making projects, and it made the company profitable like in 3 months. So what you need to understand that this business was well established. It's been running for more than 15 years, but the founding team was bored about the legacy product. They wanted to develop something new, but each new product they started developing, it was loss making. And they didn't want to realize this. It was easier for them to cannibalize the profits from UCOS rather than to dive deeper and realize that their numbers showing them to close all these loss-making products. So don't forget about this hidden segment in your financials. Don't ever let your loss-making products cannibalize your profit-making one. So let's switch to the third one. Doc Plus. Doc Plus was one of the leading Russian online medicine and telemedicine projects in 2018 and 2020. But the problem about this project was that they started scaling losses. They were trying to build a business process which didn't work in terms of unit economics because they were selling it for, I don't remember, for let's say $100 per one visit of a doctor. But this was loss-making unit economics. So they should have made it $200 or $250 per visit for the unit economics to start working. And what they did, they raised lots of money from the market, from Yandex, for example, from other large companies. They raised as far as I remember, $7.5 million from the market, but they were burning $500,000 per month. So they ended up without any cash because they started scaling losses. They scaled losses because they moved to different regions with this unprofitable business, and that's why in the end they had to sell the rest of the company to someone else on the market. So just never scale losses once again. So let's maybe switch to your toolkit. What I can suggest, what can you do tomorrow morning? You can do two things, both boring, but if you want to understand your business in more details, you need to do this. So first of all, go and get the numbers, go and calculate your unit economics. You need to understand your unit economics better. So you need to split your revenues into different segments if you have several products or projects. You need to calculate each cost. as I showed you. And so you need to have not only revenue in each column, but also costs in each column. So, and you will see which product is profitable, which is not. And it will make easier for you to make decisions on how to move on. The second one is you just need to pick one metric and start watching it weekly. For example, not 50 metrics, but just one. For example, this LTV to CAC ratio or churn rate. So just every Monday morning, you just write down the numbers, and you will see the trend in several weeks. So if the trend is down, that means a problem. But don't forget that you need to to remember about this seasonality. Some businesses have seasonality, so you need to compare like for like. So you need to compare. If you are measuring September, you need to compare it to September previous year. So don't compare September to August. So this is very important. So here's the decision framework, the decision metrics. We talked a little bit about this a couple of minutes ago. So always have a look at your LTV to CAC ratio. Also, don't forget about churn rate. When churn is rising, that means that customers leaving and something is wrong with your product. So you need to fix your retention first. You need to maybe stop on acquiring new customers. So you need to understand why customers are leaving. You need to fix your product first. So if you are bored about your current product, if you don't want to develop it anymore, if you are refocused and if you want to develop something new, I would suggest you just make a spin-off of the product. Just make it work as it is. Maybe it can become a cash cow for you if you want to develop a new product, a new project. It's better to use money from the market. So it's better to go and fundraise if you want to develop something new rather than use your profits. Because profits, you can use your profits as dividends. You can pay dividends to yourself as a founder and shareholder. You can pay dividends to your shareholders, to your investors. But don't use those profits to develop something new, something you are not sure about. So there are three takeaways from today's talk. The first one, never trust the top line, never trust the revenue growth, because revenue can grow, but at the same time, you can be burning much more money than your revenue. You might be burning much more money than cash you have. So always watch the bottom line, always watch the net profit line. So the second one is you need to segment everything. You need to deep dive into your segments. You need to understand if your business line is profitable or not. If it's not, then you need to ask yourself a question: why it's not profitable? Maybe it's not going to be profitable like in a year or 2 years. That means that you need to close this business line. Never let your business lines cannibalize what make you profits. And my favorite one is never scale losses. I have said this many times today, but this is really important. Many people don't understand this, but never scale losses, scale profits. So I'm a little bit early, but that's it. Maybe you have any questions. I'm ready to answer those. So I see the questions in the chat. So the first question is, what should the company prioritize when revenue is falling and costs are increasing? Well, I have already said this. You need to segment your revenues, you need to segment your costs, and then you will see what's happening, why your costs are increasing. Because first of all, you need to go and just cut your costs. So it depends on the business, it depends on the situation. So normally you just need to segment everything and you will see what's going on. Where is the bottleneck? Maybe you are spending too much on not effective marketing channels. Maybe maybe you've got too many in-house projects being developed which should not be developed at the moment. So it depends. I would start with the segmentation of each product line. The second question, how can you measure the real profitability of each project or product? So basically the same. So you need to segment each revenue stream, each cost stream. You need to allocate smartly. You need to allocate smartly your costs to right revenue stream. So you need to understand, for example, well, I have already said this. If you want, I can repeat it, but basically you need to understand that this product is being developed by this developer. This product is being marketed by this marketer. I spent, I don't know, $1,000 salary for this developer. I spent $1,000 for this marketer. My marketing budget is $2,000. So in total, I spent $400 on this product, and it gives me revenue of $10,000. So my profitability is $6,000. So I'm profitable enough. I can move on. Well, just numbers. You just need to segment everything correctly and smartly. Which cost should companies cut first during a crisis? Marketing. Well, first of all, you should stop. You should stop. Well, it depends on the business, first of all, but most likely you should cut your marketing costs, because normally during crises they become not that effective. So you just need to wait. You just need to think more about your retention. You just need to think more about your organic clients. So I would suggest, well, in general, it's a very good suggestion, I think. Spend more money on outreach, spend more money on organic clients. Try to make your unit economics as effective as it is, and it will help you when crisis comes. It will help you to stay sustainable, because your LTV to CAC ratio not gonna get too low. How can a company know if its growth is actually profitable? How can a company know if its growth is actually profitable? So it's just about the numbers. So you just need to, as I said, if your revenue is growing, but your losses are growing as well, that means you need to stop growing your revenue and think about why your losses are growing as well. So you need always to look at the bottom line, not the top line. How How should a company decide whether to invest in a new product during a crisis? And when should a company stop investing in a project that is not performing well? How should the company decide whether to invest in a new product during a crisis? Uh, well, it's a good question. Depends on the product, I think. Well, during a crisis, I would stop investing, and I will spend a couple of months thinking what's happening on the market, because it's hard to, well, it depends on the product. For example, I don't know which product are you talking about. So there are different products, different crises. So, well, you can contact me and contact me directly and tell me uh, which product are you talking about exactly, because it depends hugely on the product. And when should a company stop investing in a project that is not performing well? So you just answered your question. You just see that the project is not performing well. You just need to understand why, and maybe this is not a good product for the market. So people are not willing to buy it. So you just need to understand this, and you just need to stop investing in this project. It depends on the people on the market, on the customers. So how can an IT company recognize that it's entering a crisis before it becomes critical serious? How can an IT company recognize? You well, basically, it's all about your cash flow. So you just need to monitor your cash flow. So the tool number one, making correct management accounts. You need to always oversee your cash flow, your cash position. If your cash position is dropping down, you need to think about it, because you always need to have at least 6 months of run rate, in my opinion, at least. Because if you have less than 6 months of cash run rate, then I think you will become bankrupt very soon. So just use tool number one. How can you decide whether a product should be changed or completely shut down? How should the company choose between several projects when resources are limited? Well, I would be looking at profitability. As I have already said, if you are profitable, you just scale up your profits. If you are not profitable, never scale up losses. So just choose if you have several projects, just choose those projects which are profitable at the moment, and most likely will become profitable in the next couple of months. But if you don't believe in a product to become profitable in, for example, 10 months, just shut it down. If a company had only 6 months of cash left, what would you do first as a CEO? And what are the free? Okay, if a company had only 6 months of cash left, what would you do first as a CEO? Well, it's not a problem of COO, basically. It's a problem of the CEO and CFO. It depends on the product. It depends on the company. You can go, well, there are three ways to solve this problem, in my opinion. First of all, you can cut your costs. And you can, secondly, you can go to the market and try to raise money from the market, from investors. Secondly, if you are an established business, you can go and get some credit line in a bank. So, but I will start with cutting costs. And what are the three most important rules for surviving a serious business crisis? This is a very broad question. What are the three most important rules for surviving in series? Well, be financially strict. Always oversee your financials. Always. You need to be profitable. You need to be smart. So I don't know. This is a very broad question, but you need to have enough cash for the next 10, 12 months. What is the biggest challenge companies face when trying to balance growth, profitability, and financial stability during a crisis? So many questions about crises. Um, what is the biggest challenge? Well, I haven't talked about people. I haven't talked about teams. Well, one of the biggest challenges might be if you're trying to cut lots of costs, your team can leave you, for example. And if you have a very experienced, good team, this is the worst thing. The worst thing which can happen to you when you lose your team. So I don't know. Maybe this one. Which unit economics metrics are the most important for an IT company? How can unit economics show that scaling a product may actually increase losses? How can unit economics show? Well, I had a slide about this. So the unit lifetime value to customer acquisition cost ratio, this is the most important metrics for, in my opinion. And when it goes down to 2 to 1, 1 on 1, or less than 1 on 1, that means that your product actually increase losses. So we've got only 3 minutes left and several questions. How should the company decide whether to invest more resources into a struggling product or accept the losses and move on to another opportunity? Well, there is no theory about this. This is only about my personal experience. So I would look at the timeline. If a struggling product has been struggling for like more than 6 months, just accept the losses and close it, because it never stops. If if 6 months passed and you still struggling with the losses, there is no point in investing money into this product. You will just save this money and invest in a different one. For example, if you have a profitable product, just invest money in that profitable product. Um, Can you share a real situation where a difficult financial or strategic decision significantly changed the future of company, and what did you learn from that experience? Yeah, well, when I was talking about UCOS and when I was talking about restructuring UCOS, this was actually a difficult strategic decision to close lots of loss-making products, because when you, well, closing a product means that you are sacking people. That's not a pleasant one. So yeah, so when you need to sack people, this is very difficult. Uh, what I learned from that experience: don't scale up losses, don't develop loss-making products. Just invest that money into profit-making products. Just be smart. Uh, how can leaders make difficult decisions during a crisis without losing the trust and motivation of their employees? This is a very good question. Um, I don't know. Well, it depends. It depends. You need to be smart. You need to talk to your team. First of all, talk to people. People love to be heard. When you talk to them, when you hear what they say, when you are fair enough with them, when you are not lying to them, you're not going to lose their trust. That's it. Never lie to people. Basically, that's the recipe. Okay, we've got two more questions left. What are the biggest mistakes companies make when trying to reduce costs? And how can these mistakes affect their future growth? Um, uh, well, there is a Russian proverb. I don't remember how it is in English. Самое главное не выплеснуть ребенка. That means that when you reduce costs, don't cut those costs which make your the profits, right? So don't sack people who do the best job, for example. Don't reduce effective marketing channels, for example, and so on. And the last one, how can a company turn a serious crisis into an opportunity to rethink its business model and become stronger in the long term? Uh, well, well, for example, I have forgotten to mention this when we're talking about UCOS. When the COVID, you remember COVID, of course, everyone was sitting at home and many companies started developing delivery. Many companies started developing their online shops. And what happened? For example, Shopify, they grew like, I don't know, 10 times during this COVID. So you just, well, you just need a bit of luck. Sometimes you just need to be smart enough. You just need to rethink your business model. So it depends. It always depends. There is no like single recipe for this question. Okay, I think we are finished. Thank you very much for listening to me. It was a pleasure. Okay.
Да, в принципе, все хорошо. Вот. Может быть, у вас какие-то еще есть, может, пожелания для наших слушателей? Что-то в этом роде, в зависимости от вопросов, которые они задавали. Какой-то вывод, может быть.
Вывод, на самом деле, выводов несколько. То есть главный вывод всегда следить за своим финансовым состоянием с точки зрения кэшфлоу. И всегда следить за тем, что ты, у тебя есть достаточно денег на ближайшие 6-10 месяцев. И всегда нужно следить за тем, чтобы у тебя каждый продукт был прибыльным. Если нет, то лучше там еще немножко посмотреть и закрыть. То есть нужно всегда быть финансово грамотным в этом смысле. Это, наверное, самый главный совет, который я могу дать из моего опыта.
Спасибо вам большое, не смею вас задерживать больше. Спасибо
Да,
вам за
всем
выступление.
спасибо. Да, всем спасибо, до свидания.
До свидания.